A 10-year long threefold increase in the gold price, or even a full fourfold increase in the gold price, is something that a reasonable statistician could imagine with a 75% decline in the purchasing power of the US dollar. If I was modest, I would say threefold, which is $12,000. But why quibble? The gold price seems to, the silver price seems to move twice as fast as the gold price. I need to say that that's not how I invest or speculate anymore. I own physical precious metals to maintain my purchasing power rather than to speculate or to make money. But there's a whole different class of investors than I who could be expected to be attracted to the volatility and favor silver over gold. And if past is prologue, one would expect from the period that breakout occurs for silver to outpace gold roughly 2 to 1. Therefore, if you believe that the gold price for the balance of this bull market goes up 300%, it would not be out of line to speculate that the silver price could go up 600%.
The long-term trajectory for gold is not just higher, it's transformational. A decade from now, the US dollar could lose as much as 75% of its purchasing power, and gold, as it has for centuries, will be the mirror image of that decline. History has proven time and again that every era of monetary excess ends in revaluation, not by choice, but by necessity. In this cycle, a 3 to 4-fold rise in the gold price to $12,000 per ounce is not speculation, it's statistical probability. Silver, as it always does, may move twice as fast, turning volatility into opportunity for those who understand its leverage. RickRule, legendary resource investor and founder of Rule Investment Media, believes the coming bull market will echo the 1970s, volatile, emotional, but ultimately generational in scale. The key, he says, isn't timing every swing, but surviving the volatility with conviction. Gold remains the ultimate protection against political folly and monetary decay, while silver stands as the instrument of amplified opportunity. The message is simple: hold real money, not promises. Now, we present the clips from RickRule's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Gold prices go, over the course of a decade, much higher from here, not merely higher from here. But people who hope to play that game, if that's what it is, need to understand that the market will be, first of all, volatile, but will also be, within a secular bull market, cyclical. I remember very well, Michelle, the decade of the 1970s, when the gold price went from $35 an ounce to a high of $850 an ounce, a 30-fold bull market. In the middle of that amazing move, 1975, the gold price fell by half. The quote slipped from about $200, pardon me, to about $100. A whole bunch of people who had been gold faithful at 200 lost the faith at 100. They got shaken out just in time to miss a move from 100 to 850. The point of all this is that, for reasons we'll discuss later, I think the gold price is going higher, but it will not be a smooth ride higher. They never are. The gold price is really all about real interest rates, I think. By real interest rates, I mean the difference between the yield on the US 10-year Treasury, the world's benchmark saving instrument, and the deterioration in the purchasing power of the US dollar. I want to begin, and I think you agree with me in this, Michelle, I've listened to your work, that the CPI is not an accurate measure of the deterioration of the purchasing power of the US dollar. Mm-hmm. Anybody who buys stuff can look at the price of consumer goods in the period, say 2020 to 2025, and they know that we aren't suffering from 2.5% inflation. As you point out, it was Paul Volcker allowing interest rates to go up to 18 or 19% that broke the back of the gold rally, because it made other savings and investment products more attractive than gold. I believe that, very similarly to the decade of the 70s, the US dollar will, in the next 10 years, lose 75% of its absolute purchasing power. I believe we'll do that because of on-balance sheet and off-balance sheet deficits in the US government, relative both to gross government income, but also relative to the size of the GDP. I don't think that we have the political will to have a default in terms of off-balance sheet obligations. So I think we'll have a stealth default, a default where we inflate away the net present value of the obligations. I believe further, Michelle, that the decline in the real purchasing power of the U.S. dollar, the absolute decline in the purchasing power of the U.S. dollar, will generate a nominal, which is to say US dollar gold quote, that mirrors the decline in purchasing power. So a 10-year long threefold increase in the gold price, or even a full fourfold increase in the gold price, is something that a reasonable statistician could imagine with a 75% decline in the purchasing power of the US dollar. If I was modest, I would say threefold, which is $12,000. But why quibble? At some point in time in a precious metals bull market, when the generalist comes into the market, I think we're just seeing that now, silver begins to outpace gold. Please don't ask me why, because I don't know. I just don't. I just know that. Perhaps it's the lower unit price. But in the three precious metals bull markets that I've lived through, at some point in time, silver decouples from gold. Perhaps we've seen that in the last 4 weeks. And when that happens, for a time at least, the silver price seems to move twice as fast as the gold price. I need to say that that's not how I invest or speculate anymore. I own physical precious metals to maintain my purchasing power rather than to speculate or to make money. But there's a whole different class of investors than I who could be expected to be attracted to the volatility and favor silver over gold. And if past is prologue, one would expect from the period that breakout occurs for silver to outpace gold roughly 2 to 1. Therefore, if you believe that the gold price for the balance of this bull market goes up 300%, it would not be out of line to speculate that the silver price could go up 600%. By absolute purchasing power, I mean the US dollar versus itself, rather than the Canadian dollar, the Swiss franc, or the euros. I think that the US will hold its own against other currencies in relative purchasing power. My friend Doug Casey says the US dollar is the worst currency in the world with the sole exception of all of the others. And so, well, diversifying out of the dollar into other currencies, I don't think gives people the absolute protection or even the relative protection that maintaining savings in gold would generate. And I absolutely concur with your previous remark, which is to say, since the establishment of the Federal Reserve, the US dollar has lost 97% of its purchasing power, a little bit at a time. We had a dramatic downshift in the purchasing power of the US dollar in the period 1970 to 1980, a recovery. A percentage recovery, at least in the early part of the decade of the 1980s. And I think that we're headed back into a period where the downward trajectory in the real purchasing power of the US dollar gains momentum. Surrender it, and you can receive gold for that. That,
Right.
in and of its nature, requires prudent governance.
Sure.
A government that spends within its means and can service its debt. Being a politician in such a circumstance is no fun whatsoever. Can you imagine, as an example, our president being constrained in his big, beautiful budget by how much gold he had in the treasury that he could distribute to U.S. savers? Could you imagine President Xi doing the same thing? People are politicians because they want to exercise power. Gold constrains the politician's power, which is the reason that the people like it. The idea that the politicians would willingly give up the thing that they strive for in life most, which is power, is inconceivable to me. Now, I do believe that individuals can and should have their own gold reserve. I personally save in gold. I maintain liquidity in US dollars. Those are very, very different words. And if you have saved in gold systematically, as I have for 25 years, and you look at the prices of goods and services in 25 years, you are struck by how cheap things are. If by contrast, for that portion of your account that you maintain in dollars, you're struck by how expensive things are. So while at the same time, I don't believe that I will in my lifetime or you in your lifetime see gold function as a real reserve currency, which is to say a direct currency, I do believe that individuals can and should structure their own life in a way where, at least with regards to their savings, they monetize their host fiat currency into gold. I think the Nixon presidency is the best thing to consider historically with regards to that, which is to say that some countries will likely have a gold link, particularly the BRICS countries, for as long as they can. You'll remember that the United States, not for its own citizens, who were obviously second class, but rather for the world, had convertibility of US dollars to gold until it was inconvenient. At which point in time, President Nixon said, too bad, so sad, big lie, strong letter to follow. My suspicion is that the BRICS proposal, where they enter into bilateral transactions either in a BRIC central currency or in their individual currency, and there is convertibility in China, conveniently, from those currencies into gold, will last until it doesn't. And then I suspect that Putin's nickname will be Nixon, and Lula's nickname will be Nixon. And whoever the guy is now that runs Iran, his nickname will be Nixon. In other words, they will have convertibility from their fiat trash into gold for as long as they can honor it. And after that, they'll repudiate it. I think that for central banks, gold will be of much more interest, if for no other reason than gold is cheap to store. It doesn't take much space.
Mm-hmm.
I remember visiting the Sprott physical gold holdings in Ottawa and being distressed over what a small pile, what was then $3 billion worth of gold was. It was really disheartening for me. And then to cheer me up, they took me into the Sprott silver room. And that was a very, very, very different spectacle to behold. And I think if you're a central bank, the idea that if you have to store it and ship it and stuff like that.
The silver market today stands as one of the most distorted and volatile asset classes on the planet, a system built on excessive leverage, paper promises, and fragile confidence. Each day, futures contracts trade at volumes hundreds of times greater than the physical silver available for good delivery. It's a structure that functions until too many participants demand the real thing. When that balance tips, exchanges won't allow chaos. They'll halt trading, impose a settlement price, and cash out the claims. Yet even that solution could reprice silver dramatically higher as supply tightens and demand for tangible metal surges. Beyond the futures market, the physical side tells its own story. Retail shortages persist while large-scale bullion remains available only to institutional buyers. This divide between paper and physical markets exposes a system nearing its breaking point. Silver's volatility isn't a flaw. It's the signal of a monetary metal awakening and reclaiming its proper role in global finance. Let's get back to the interview.
You know, the ETFs, the Sprott physical products, because I think those are accounted for in the silver market. The claims that have always bothered me are the claims in the futures market. It is not uncommon for the daily volume of futures obligations in the silver market, the daily volume, to exceed by a factor of 200 times, not 200%, but rather 200 times the amount of physical silver available for good delivery. This is an extremely, extremely leveraged market. Now, virtually all of those claims, until very recently, cash settled, which is to say they weren't held for maturity. They were rolled over very recently because of location disparities, which is to say the London market not having enough gold. There was a location premium for gold in London. And what that meant was futures holders in the US would actually take delivery of the physical silver and ship it to London to take advantage of as much as a 4% disparity in the London quote and the Chicago quote that was contemporaneous. A 1 day 4% premium. When that happened, the gold lease rates in the United States skyrocketed because rather than leasing gold it was easy to make 2 or 3 or 4% simply shipping that gold to London. What has always scared me was an imbalance between supply and demand, between the physical gold and that paper gold, if more people stood for delivery. Make no mistake, Michelle, if you have a real imbalance in the futures market, you are not going to engineer the massive short squeeze that the silver people hope for. What the exchange will do is that they will halt silver trading. They will
Mm.
set an arbitrary price between buyers and sellers, and they will cash settle. That's what will happen. The exchanges run for the exchange members' benefit. That notwithstanding, that sort of market turmoil, what is likely to be the agreed upon cash settlement price, were that shortage to occur, I think would likely be dramatically higher in the circumstance that we see today than the price is today. And the dislocation in a market where 200 times the claims, uh, where there are 200 times the claims relative to the amount available to settle on a daily basis, is a market that's really, really, really ripe for disruption. If you look at the physical silver available uh, in North American futures markets on the COMEX as an example, good delivery silver in system available for the settlement of the claims, it is not unheard of to have 200 times that amount of silver traded in contracts on a daily basis. Now, the huge majority of those things cash settle. They aren't
Mm-hmm.
presented for delivery. But in a situation where you have these goofy location swaps, 4% difference in spot price between London and Chicago, it's very tempting to take delivery, ship it, and grab the money. So all of a sudden, you had a situation where uh, the held for delivery proportion of those trades relative to the cash settlement portion of those trades went up, and the COMEX got stressed. I'm sure that your channel's employer, has also seen a remarkable shortage of small denomination physical silver products, the 1 ounce products, the 10-ounce products. We've noticed at Sprott that there is no shortage of silver available to us in good delivery in wholesale quantities. In other words, the bullion banks have been able to supply Sprott with the physical silver that they need. But the dealers have had a very difficult time keeping retail denominations in stock. They've also had a very difficult time hedging their silver inventories and leasing silver inventories to make available inventory to their clients on a short-term basis. There's been a dramatic turmoil in the silver market. Your own sponsor being one of the few that seems to have been able to stick handle their way through this crisis in good order and service their clients. Silver is, as far as I know, the most volatile, highly valuable commodity on the planet. The ratios, at least when I monitored for gold, were much less extreme because gold, although volatile, is nowhere near as volatile as silver. And the time premiums and the volatility premiums in futures markets for other materials seems to be nowhere near as extreme as it is in the silver market. There was also, I think, for 40 years probably, an institutional bias that the silver price was declining, while there was a popular bias that the silver price was increasing. So you had a natural war between buyers and sellers on the COMEX. I think that the institutional bias is much less likely to be short now than it used to be. And perhaps as a consequence of that, the volatility will die down. But in direct answer to the question, I don't know of any other commodity in the planet that had the mismatch between the claims volume, which is to say the futures volume, and the amount available for good delivery. Well, the manipulators can only go so long. It is alleged that in my youth, I constructed several short squeezes. Those are short-term phenomenon. I'm not somebody who believes that there's been a 30 or 40-year thoroughgoing conspiracy to depress the price of silver. You didn't have to do it because most of the time the price of silver was going down. Why would you strive mightily to do something that was going to happen via gravity? But I know that all markets in the near term are manipulated. The LIBOR market has been manipulated. The U.S. Treasury market has been manipulated. Those are much larger markets than the silver market. And in a market where the futures volume is so large relative to the amount available for good delivery, near-term market manipulation, albeit expensive, is really ludicrously easy. If you were going to do it on the short side, you construct a short ladder in the futures market, 3 months, 6 months, 12 months, 18 months, something like that. You develop a good size short position. For fun, we'll call it $1 billion. You borrow a bunch of physical silver and you sell that physical silver as aggressively as you can during the most illiquid part of the trading day, attempting, as an example, to drive down the silver price 3%, 4%, 5%, and have that precipitous decline in the physical market impact the quotes in the futures market. Cover your shorts on lock limit down days, pay back the silver that you owned, and walk away with a profit. I remember in the decade of the 70s where there was allegations that exactly that same type of manipulation happened on the long side. Manipulators generally do what's easiest if there's a negative bias. But the idea that silver markets aren't in the near term manipulated is extremely naive. The reason why one would invest in silver is because you don't care much about the noise, the trading noise in the near term. If you believe, as an example, like RickRule, that the nominal price of gold has a threefold upside, what happens next Friday is of very little consequence to your belief. To me, the intraday, frankly, the inter-month price moves are irrelevant. I'm thinking in 4-year terms, 5-year times, and I'm thinking in terms of quantum moves.
Mm-hmm.
The difference for me between $40 and $42 is absolutely inconsequential. It just absolutely doesn't matter. And I would argue that most speculators who think that they can outguess the bullion banks or the big financial syndicates, short syndicates, are delusional. The official monetary metal is gold. It's what the central banks save in. They don't save in silver. And traditionally, hard money aficionados, those people who own gold for the same reason I do, to maintain their purchasing power, haven't paid attention to silver. But in some parts of the world, South Asia in particular, Bangladesh, India, Pakistan, Sri Lanka, silver is in fact a monetary metal. It's a form of savings that's simultaneously a medium of exchange. Silver is often viewed, particularly in bear markets, as an industrial metal. The truth is that in that circumstance, the high silver price decreases the industrial utilization of silver. I actually believe that silver is a de facto monetary metal, but it masquerades partially because it's only regarded as a monetary metal in South Asia and to a lesser extent in the Middle East, not universally. And also because in Western financial markets, it's viewed as much as an industrial material as it is a precious metal. I very much believe it's a precious metal, and I very much believe over the next 10 years that silver, at least for private transactions, will allow silver to become both a medium of exchange and a store of value. I believe that we will see widespread utilization of physical redeemable silver in the form of linked tokens, which is to say that silver increasingly, I think, will trade online. And when that happens, when you can use your phone to buy a cup of coffee at Starbucks in fractions of a gram of silver, silver will become at once a store of value and a medium of exchange. And I think that'll happen easily in the next 10 years.
The silver story is no longer just about supply and demand. It's about trust, leverage, and a global awakening to real value. The decades of paper dominance are nearing their limit, And when confidence in futures evaporates, only physical metal will matter. Silver's volatility, often misunderstood, is simply the market revealing its pressure points before a structural repricing takes place. This isn't speculation. It's the natural consequence of decades of monetary distortion and financial engineering. As the world drifts toward asset-backed systems and digital redeemable metals, silver's role as both a store of value and a medium of exchange will expand dramatically. The next decade could see silver transition from a forgotten asset to an essential reserve. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.